Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and today we're joined with Andrew Fisher over at Semper Home Loans and a special guest. Haven't seen her before, but you may see more of her. Her name is Haelie Schnapp. Did I say that right? Haelie
Yep.
Schnapp at Xperia Credit, and she does credit repair. So she's a wealth of knowledge for even if you're not in the worst of credit, maybe even get better credit. So today we're going to be talking a little bit about that and what a little bit about the current market and some tips and tricks. So um, the first thing I just wanted to kind of bring up is that right now this time of year, every year is a good time to be a home buyer because things sit on the market a little bit longer. Even if you're listing, there's serious buyers out there if you're listing your property, and but you can get a lot of deals as a buyer. So you can kind of look at it from one side or the other if you're trying to sell and buy. But um, just because things sit a little bit longer, it's the holiday season. So if there are buyers out there, they're very serious buyers. Um, and it still is a good time to kind of look at your options. So one of the things that I wanted to share really quick, if I could, is that we're actually in a buyer's market. So this chart basically tells us that we're in a buyer's market because it's below 100 and below the 90 mark, which kind of puts us in a buyer's or balance range, but we're actually at 78. So since we're below that 90 mark of the range of being in a balanced market, we are definitely in the greater Phoenix area in a buyer's market. So that's kind of what we're going to be talking about today and how you can really maximize your ability to make this happen. So, um, Andrew, did you want to say something really quick about kind of what you guys offer and how we can help people this time of year?
Yeah, absolutely. So, and the great part with you're completely right, being in a buyer's market from real world, what we're seeing on the mortgage side is biggest thing, buyer's market, seller concessions. Not necessarily dropping the price of homes, but being able to use seller credits to negotiate and pay down your closing costs and buy down your interest rate. So, if you have an interest rate, which they are a little bit higher right now than what people are expecting, conventionals were in the six and sevens, government loans, FHA and VA were in the fives and sixes. The great part with being in a buyer's market is, hey, maybe you can request a seller to buy down your interest rate, which save you significantly, a couple $100s a month. I mean, even going from the sixes to the fives, greatly improves the amount of interest you're paying over the life of the loan. So when you look at, hey, for example, if you go from 6.25 to 5.75. I mean, at a 386 loan amount, we're talking roughly, give or take about $50,000 in interest. You're paying over the life of the loan. So even if the price of the home isn't dropping, you're still saving a lot of money. And you could potentially, especially with loans like the VA, where you're doing zero down, you could come to closing not paying a dime out of your pocket.
Yeah, yeah, that's a great deal. Absolutely. But buy down rates right now are a big thing because even though rates have come down quite a bit, I mean, we were at 8% not that long ago, and just this year they've gone down from like 7 into the low sixes. So we're definitely in a rate reduction cycle, which is wonderful. I mean, I just saw the most recent stats. I mean, people are basically saving almost $300 a month just this year, just doing nothing but going out and getting a basic out of the box home loan right now without even getting into the buy downs. And we can work with you guys to get that interest rate down. And we're talking significantly. We've had some people where they're getting 100 to 200 basis points, which is basically 1 to 2%, or even more in some cases, with a fixed rate or with the first, second, and third year being a reduction, and then it stays fixed from there. And they're not like the crazy rates during the crash. You have to actually qualify for a little bit higher rate, but you have that amazing savings on your monthly payment. So with that, we have a lot of people who come through that maybe would like to look at improving their credit or, can't buy because their credit is too low. So Haley, why don't you explain a little bit on how you could really help people kind of maximize their buying power?
Absolutely. So really your credit just as an overall, it represents your behavior as a borrower, right? That's all it is. It has nothing to do with your income. It's all about how you borrow money and how you pay it back, if at all, right? And so
Yeah.
knowing that that is a direct representation of you, it is a huge, huge factor, therefore, into the qualification itself. And so, yes, there's a lot of different ranges of scores. There's a lot of different industries of scores. Um, and so our goal is to make that simple, right? We want to make sure that you're maximizing your score. If there's items that you're aware of that are hurting the score, if you have maybe debts that you didn't pay, or maybe just getting a matter of getting caught up, right? There are definitely tips and tricks, but also a strategic play where you want to be able to actually help your score without hurting it in any way. There are ways where, contrary to common sense, credit doesn't work on common sense. And we can definitely explain that more on a tailored plan per client. But essentially, what we want to do is assess the damage, whatever's hurting your score, causing it to be lower. We want to get that attacked with the goal of removal off of the report. So you're naturally increased. And then on the other hand, too, we want to make sure you're getting all of the coaching, all of the guidance, the benefits of building on your positive credit as well. Now, ultimately, there is and I'll break this down. I'll show you what a FICO pie chart looks like. FICO pie chart is really, really important. Essentially, it is the breakdown of what it is exactly. What is a mortgage score? What is it made out of? And so ultimately, that's what this is here. There's five pieces, right, to this score itself. And essentially what that means is there's the 35%, I'll just break it down briefly. 35%, that's where your negative items are living. There's amounts owed, that's specifically your credit cards, how you're maintaining what balances you're carrying on those credit cards. 30%, it's a second largest portion, very, very important one too. And then you have new credit, your inquiries live there, your age, 15% of your score, and then credit mix, that 10%. So all of these, they interact with each other. They do weigh differently on the score, but they do have a direct impact per file. So credit's like a fingerprint, you know what I mean? It's specific to you, your behavior alone, who you choose to finance with, how many banks you choose to finance with, how much you borrow on an individual basis. And so all of those key things play a role into the overall score itself. And so our goal is to not only shed the weight of what's hurting the score, but we also want to build on every point we possibly can from every angle possible to where you have as many options available to you as possible, but also that you have a better rate that you're locked into for the life of the loan, right? Credit has a direct impact on interest, what you qualify for, and all of that on an individual basis is what we like to break down. So, um, to give you a brief run through, Chris, on that.
Yeah. No, that's great. And one of the things that, we've dealt with some credit repair companies in the past, and they've been good, but I've see, how knowledgeable you are and how you're really wanting to focus in on getting things, accomplished quickly. Can you really explain kind of the difference in your services? Because it seems like some of these companies, they'll drag things out and just trying to keep charging fees. Let's just put it that way.
Absolutely.
Um, and can you kind of maybe explain a little bit more about your company's approach?
Absolutely. So, typically, all of our clients, given that they're so individual based with their own circumstances, we want to first diagnose what your credit is needing. What are your needs as an individual? So, we always like to offer a free credit consultation on behalf of Chris and Andrew. This helps diagnose what next steps look like for you. Your next steps were going to be totally individual to even what your spouse next steps may look like. It's literally that individual basis. So once we have a diagnosis, we want to get you not only through the program as quick as possible, but the quicker we could do that, the quicker you're into the home, the better for everyone all the way around, right? You've reached your goal. So us as a foundation, we're solely based as a referral based company. most credit repair companies, there's 40,000 that are registered as of 2024. We're gonna probably have a new number once 2025 is complete. But 40,000 companies, there's a lot of different strategies, a lot of different ethics, if you will, too. I know credit repair doesn't always have the best rep overall, but there is a good reason for it too, right? Because most companies are retention based. Uh, Lexington Law, I'll give you an example of that.
I'm
They're
glad you said it.
yeah, Lexington's usually
And
retention.
they're done that.
Yeah. Yes, I mean, we have a lot of clients that are like, "Oh my gosh, I haven't really seen progress, or I didn't get any coaching, or whatever the case is." And they're the largest in the nation. And
Yeah.
there's again, that just shows you could be the largest, biggest, and greatest, but does that mean you have the best results? Not necessarily, right?
Yeah. And we've had, we haven't, uh, referred anybody to them, but we've had people come to us from there
Right.
and they're just like, I'm just like, it's not going anywhere, and they're
Right.
trying to do all the things,
Right.
but
Exactly.
yeah. So I've noticed with you guys, it's a totally different experience. Yeah. So, Andrew, along those lines of a company experience, can you explain a little bit too, really quick, about the difference between, because everybody thinks a loan officer is a loan officer.
Right.
So, or I'll just go to my bank. Why would they not want to go to their bank or any loan officer or certain loan officers for that matter or companies versus what you are? And just to put it out there, you're a mortgage broker. So kind of explain the difference and why that's important.
Yeah, 100%. So, and the big thing with that is you have different types of lenders. Like you said, there's hundreds of thousands of loan officers. You can see who's registered everywhere. With that, you have your banks, your direct lenders. So your banks, of course, Chase, Wells Fargo, direct lenders. So maybe you've heard of, Rocket or some of these other big companies that have advertisements. Being a mortgage broker, what that means is we shop wholesale lines for the best interest rate. So most brokers have access to about over 100 different wholesale lenders that only cater to mortgage brokers. With us, the difference at our company is we consistently shop and use those different lenders. We don't send them to just one or two lenders consistently. So if you're going through your bank, they are looking, whatever interest rate they can offer you and putting you into their program. Whereas as a consumer, you may not fit into their program. As a broker, we're trying to find alternatives. We basically have a solution for, anyone who can't get a mortgage or wants to get pre-approved for more, save money on their interest rate. So we're shopping different wholesale lines. And honestly, the big part of it too is, these banks and direct lenders, you see them everywhere because they're spending hundreds of thousands of dollars a week, on advertising at gas stations, billboards, TV shows, and buying up stadiums, right? Whereas our approach is, hey, we don't charge any junk underwriting, processing, application fees. Our job is to just get you the best interest rate, lowest closing costs, and, not just do your first loan for you, but your next three or four and all your friends and family.
Yeah. Yeah, and that's kind of always my approach is solution based, where you want to, provide the best service. I know for me, if someone's working with a bank, they're not gonna I just know they're not gonna close on time. It's just not gonna happen because, dealt with it in the past and it's like they work 9 to 5. If they go on vacation, nobody knows where the file is. Nobody picks up the file, that sort of thing. I've had circumstances where somebody had to drive from a different part of town to get that file to actually work on it when the other person was gone 2 or 3 weeks. They can't get you can't get a hold of anybody on the weekends or evenings when you're actually looking at properties and you have questions for your loan officer. So those are big things when you're trying to close on time. That's obviously a big thing. You're trying to figure out moving trucks and turning on utilities and all that, and it's just a nightmare. But the big thing is you guys shopping the best rates, and then you basically don't do some of the other big advertising like a Bank of America or some of the other big retail mortgage companies, right? You're working through your agents, through word of mouth. So obviously that customer experience has to be stellar for that to happen, but that also means that savings gets passed on to the consumer. Would that be correct?
Yes, it is.
Yeah.
Yeah, we're 100% referral based. And yeah, we try to give the best experience as well as the best interest rate and savings. We're not passing on any costs. And um, with that too is we don't, you go to a bank and hey, maybe you don't qualify for their program. But with us, we try to, again, solution based. And we don't charge more for, hey, you're doing this loan or this is your credit score or you're putting this much money down. Whether I send it to, one lender, two lenders, three lenders, we get paid, exactly the same amount every single time. So I'm not going to try to puzzle you in where it's going to make me the most money. We are a true fiduciary for our clients.
Yeah, yeah, that's great. That's great. I mean, I've had circumstances with your company where somebody doesn't qualify with another LO or company, or they don't qualify for enough for what they really want, and then we're able to actually find a solution to that because you know how to navigate that, and you're offering, that extra mile that you go into figuring out what lender may work, lower fees, so now they can qualify for what they really want, or
Yeah.
save that money or put more towards their principal. Um,
Yeah, because most banks or direct lenders aren't going to, they'll offer their conventional loans, FHA loans, VA loans, but most aren't going to offer, down payment assistance, going with no money down, bank statement loans for self-employed borrowers who don't qualify off tax returns, debt service coverage ratio loans, which is more for investors and, not looking at income, but looking at the rental potential of the property. Most banks aren't going to offer that, so we can truly find a solution for everybody.
Yeah, I mean, guys out for those anybody listening, you've got down payment assistance, you've got lower interest rate options out of the box without even getting into the buy down rates and stuff, and the fees that you're saving. I mean, I don't want to throw out numbers, but what would you say a person just with an average credit score, what are they going to save just on fees and stuff, probably?
I mean, compared to, again, they usually build a little bit more into the rate, but our average loan amount out here in Arizona is about, Maricopa County, about 386. I mean, that could be a few $100s a month, just interest rate alone, what you're saving on your monthly payment. Your out-of-pocket costs, of course, we don't charge any junk application processing, underwriting fees. You save potentially thousands of dollars, which could be the difference between coming into closing, with $5,000 to $10,000 or maybe coming in with no money at all. It could be all the difference.
Yeah, and along those lines, and maybe Haelie, you could chime into this too. Just pulling credit or soft credit pulls, Andrew, and then Haelie, will pass it back to you. How does that work with your credit? Like people are usually worried about that, or their maybe shopping rates. What does that look like, Andrew? And then we'll toss it to Haelie.
Yeah, so in credit scores, a lot of customers they'll contact us and say, hey, we want to pull our credit scores, who we qualify for. And the first instinct is, hey, my interest, it's going to determine my interest rate. And the big thing with credit is we're not just looking at your interest rate, we're looking at what you can qualify for, your debt to income ratio, how much you owe on credit cards, auto loans, how much you're paying every single month, if you have any housing or rental collections, which could be a big stopper there. So where we, refer it off to Haelie is we never say no to a client, right? It's always, hey, maybe you're not qualified right now, but let's come up with a game plan so you are ready. And where Haelie excels at that is a lot of credit repair companies just look at, okay, how can we boost your score instead of looking at, hey, we need to see how can we, take care of some of these collections, where it makes the most impact on your mortgage score. Because there are so many different credit scores that or credit FICO algorithms that I can't keep track of.
Yeah, and that's where Haelie comes in. So Haelie, along those lines, can you touch on that, and then also kind of the difference in what you guys do as far as your not only your services but your fees and stuff that people usually just
Mhm.
seem like, well, it's credit repair, but I can't afford the credit repair kind of a talk
Right,
or
right.
issue.
Absolutely. I mean, it's true, right? I mean, I can't tell you how many people or clients come in with, well, my lender said my score is, a 550, but on Credit Karma, it shows a, 620, and that's
Yeah.
what they said I needed a 620, and I could prove it to you right here that I have a 620, and so, I mean, granted, credit is confusing. I was confused before I even got into this. I'm like, yeah, that is true. I don't know what to tell you when it comes to that, before I even started here. But yeah, there's actually so two main industries in the credit game, Vantage being one, and then FICO being the long-lasting mother, I should say, of credit. You know, they've been in the game for decades now at this point, and Fannie and Freddie have actually chosen them as the standard to go by, right? So, because of that, there's actually over 50 different FICO algorithms, eight specifically designated at this point in time for the mortgage. That can change at any point in time, right? There's always talk of change. Granted, things don't change super fast in the credit space. So, you know, it's one of those things that we kind of just hang on to and keep up to date with. But yeah, no, those are some key differences, right? And so if shopping is just something clients typically do, but typically we wouldn't recommend shopping if you can avoid it. Reason being, I've seen it, and you can't ever predict what scores or algorithms that whoever you're pulling credit from is going to use, given that there's eight, right? And so a lot of times the less you can pull credit, the better. Because I've seen every single inquiry pop up on a credit report and it hurt a client. You know, and like I said, it's just so there's so many moving parts and variables. You can't guarantee what algorithm is going to be used in every single poll for every single bank you go to. It's a risk, and every point makes a difference. Truthfully, I've seen denials from 1 point off. And if you can retain every point you possibly can, that's where it really, really counts. But also, the goal is to maximize your credit, right? You want to get qualifiable, but the higher you get, the more options you have, right? The more reward. So you want to make sure that you're actually effectively maintaining every point that you can, whether that's avoiding your pulls and not shopping around, whether that is not spending credit or using your credit cards for the holidays, using your debit card instead. You know, there's a lot of impact where you don't realize, but again, just knowing that your credit has is a representation of your risk. What behavior am I showing then to determine my risk? Is it going to be a less risk or is it going to be higher risk, depending on how I'm managing my credit? That's the mindset you want to have because that's going to help you determine what to do, what not to do. And that's part of the coaching that we cover too, even from that free consultation. So
Yeah, and really quick, I'm just going to share this other mortgage applications see the strongest week since September.
right.
So we've got a lot of people out there right now, guys, who are thinking about buying. The reason why I bring that up is because the more and more that ramps up as interest rates stay closer to six, go down from there, we're
Mhm.
obviously going to get more demand.
Mhm.
So right now you're getting all these concessions, closing costs paid for, rate buy downs, all these things that Andrew and Haelie and I can help you navigate through. Are those going to happen, as people jump back in the market and we see, sales go up a half a million to five, to another million? They say for every 100 basis point cut, we have, about 5 million more people that can, not that they will, but that can jump back into the market. So it's just something to really think about. Average equity gains each year about 4 to 5% in the greater Phoenix area, and in most places around the country, they may be 3 to 4%. So it's really a good time to look at these. You don't have to do anything. There's no obligation. Haelie would have a quick talk with you without having to flip a bill. Same thing with Andrew and I. So it's definitely a good time to start talking about things, even if you don't feel like you can afford it right now. After you go through it all, at least you're not just making things up or listening to the media, which is typically wrong, especially in everybody's hyper local area or situation out of their own pocketbook. So, yeah, Andrew, did you have anything else you wanted to add to the discussion at all, or?
Yeah, I'll just touch on your last point there. I always recommend, hey, even if you think you're not necessarily ready, if you don't have a down payment saved up, or if you think your credit isn't there, again, it's not like you're applying for a credit card here where, hey, approved or denied. It's let's come up with a game plan. So when you are ready, because maybe you think you need 20, 10% down, maybe we can find a down payment assistance option that works for you. Maybe you think your 580 score isn't good enough, and it could be even a little bit higher, or it's something we can work with. So I would say while the getting's good right now, you can have the seller pay most of your stuff for you. I wouldn't wait. Because like you said, the rates are going to come down. demand is going to go up. And we saw what happened a few years ago when rates were at their lowest and people were, hey, I can purchase this home. And they're saying, hey, you can't take it without a cash offer, So I would
Yeah.
say don't wait. At least let us come up with a game plan so we can see when the exact time is ready and you're not just working on imaginary things.
Yeah, and guys, just so you know, this isn't a sales pitch. Rates probably aren't going to be down to 3 or 4% again, unless we have another pandemic or something. I mean, the last time they were at 4% was like around the crash and
Mhm.
World War II when they were around 4% or lower. Unless you get a buy down rate to that. I mean, out of the box, they've only been that low a couple times in the history of buying homes, unless,
True. Yeah.
unless you're getting those concessions. So really, the 6% range is kind of the average. Over the last 80 years that's kind of an average, really. Again, if you can't afford it, you can't afford it. But you can always refinance later. There's options there, right, Andrew? We could definitely look
Yes.
at that. And Haelie, long term, how would you look at this right now in the current climate, really quick?
Yeah, I mean, honestly, it's always important to invest now in your credit. It's one of those things if you want to buy at all next year, credit's not one of those things that's overnight. It's not a necessary or it's not necessarily a overnight one and done kind of strategy. There's laws in place, there's terms that we have to work within. And all of that, like I said, to just get a taste, I recommend that free consultation. It is a free consultation on behalf of Chris and Andrew. So without any obligation, yeah, still get the education, take that, do it on your own, take it and go back later, whatever the case is. But starting on your credit, check every box you can in advance before just applying. You just want to make sure you have the best chances possible while there is a lot of leverage in the market right now. So definitely
Yeah.
just recommend taking advantage of the state things are in because you have a lot more leverage than you would think.
Yeah, it's better to start talking earlier rather than later so that Andrew and Haelie and I can kind of look at the whole situation and then really put a game plan together. Usually when these rates go down, if they stay lower, like around 6, or, if they go lower than that, usually it takes about 6 to 12 months for whatever the Fed or the bond market's doing, that affect that 30-year or the interest rates in general, without getting into the weeds of that. Usually takes about 6 to 12, maybe 18 months for all that to kind of really take effect. So when you're thinking about, well, how much time do I have if you're telling me the truth? That kind of gives you an idea where you're at. And that's kind of when you want to start having those conversations is like now, if you're thinking, hey, I'm going to be moving in the spring, I can't move right now, but in the spring I'm going to move, or right after the new year, or right now, I would like to look into getting those deals at the end of the year. Well, sooner rather than later, that way you're really ready for the market and buying something or selling and buying whatever you're doing, or looking at refinance or whatever it is. So,
Exactly.
all right, guys.
Awesome.
I think that's enough for them now before they get information overload. We are going to be, hopefully in the next month or two, we're going to try to put a webinar together. So we'll be getting that out to all our socials and databases and everything. We may even be able to include a title person in on that that can also get into some of that detail on that side of things. So, yeah, guys. Again, how do they get a hold of you, Haelie?
They can typically you can reach out to me directly. I have a team consultant, lead consultant specialist on my team, but usually Chris or Andrew are connecting you guys originally from your guys' conversation. So we'll
Awesome.
get you set up streamline. Yep.
Awesome. And you, Andrew, how do they follow you on social or reach out to you?
Yeah, reach out to me anytime. My email is andrew@semperfiloans.com. And at any time, my personal cell, which is 623-826-6147.
Okay. Great. And you guys know how to get a hold of me, 480-788-8569, or check us out at mincolagroup.com or mincolahomes.com. I tried to put both websites together there. Sorry about that. And you can always follow us on Instagram, YouTube, Facebook, all that's good stuff.